coming in from what part of the world? Our your friend and mine. I know we've got it here. Welcome back, Todd Halterman. How you doing, buddy?
Man, it's an amazing Monday. Happy Halloween.
Happy Halloween. We're trick-or-treating, and here's I didn't even think of this until you just said that, Todd. So here it is. If you do absolutely nothing today about your financial future, trick's on you. If you take action, hey, I don't know. I can't guarantee anything. We don't do that on Ron Single Radio, but you might have a treat in the next 10, 20, 30 years. So what do you got on your mind today, Todd? I know we talk a lot about protection. Sometimes if you don't lose money, that's just as good as making money, or maybe even better.
Yeah. Well, something to be said about protecting yourself. And we know that the teams that have the best defense win championships.
We don't want to hear about that, Todd. I was watching my Rams yesterday, and I have two teams. I have two football teams that I watch a lot. I watch the Rams, and I watch USC, and they both have forgotten anything about defense. I don't think defense is part of their vocabulary. They just, SC feels if they score 100 points a game in football, they should be able to win. They did prove against Utah that if you score 42, it doesn't get you a win.
Right. Well, my Phillies are looking good. They're playing hard defense to keep that small ball going.
You know something, and that was a Gene Mock that was in that world of small ball.
Yeah, baby. One base at a time.
So Phillies, you're watching they don't play today, do they? They play today.
They're going back home to play, so I think they take a day off. But
okay. Well, I think maybe it was yesterday was their day off. Okay, so
yesterday I lose track. Yesterday I was doing chores.
Yeah, well, when you're up there in God's country, every day is Sunday or Saturday or whatever. So, the rest of us are out here working and all that good stuff.
Oh yeah.
So tell me what's going on. I mean, protection. Let's talk about protecting. Is there a way to protect our 401k or 201k, whatever it might be now?
Yeah, right now everybody's worrying, hey, man, how do I position myself when this thing turns around? But boy, I don't want to lose another 10, 15%. And we're hearing that conversation a lot right now. I have to remind people the market standard deviation is almost 20%. So if you're a stock market investor, the markets went up between 55 and 60% from 19 through 21. And it's given back a year of those gains. And that's just a standard deviation that we would expect at any time in the market. Now, with all the
I studied some of this stuff and I don't get it. I'm a simple guy. What is a standard deviation?
That means at any time that you invest in stocks in this stock market, you have to be willing to accept a 20% variance of the price you buy at. That means at any time the market can move 20% down or up. And, in the last week, it's had a nice little technical climb up 4%. In July, it was up 7%. These are signs of how much capital and how much corporations have in profit. Every time we see earnings, we see the market move up, but then we have politics at hand and the Fed and fiscal policies and Russia and Ukraine and all the global macro noise out there, and the market started sliding again. So yes, people are worried about protecting themselves from another dip down.
So if I were to go and see a quality stock, and I'm not going to use any names, we're just going to talk about a quality stock, and I see that it's down 20%, does that mean that might be time for me to start nibbling at the purchasing apple?
Well, your most successful investors buy things when they're on sale. They don't stay at home and freeze and not go shopping. So we have Black Friday coming up, and most of America goes out and does the silly 4 a.m. thing because they want things on sale. But you take the stock market down 20% with very profitable companies, and people run scared. It's counterintuitive, Ron, and right now is the time to be looking for things on sale that are profitable, that are fundamentally supported, and then start trickling your investments in. You can never time the market, but your strategies can be what I call buying things while they're on sale.
So I'm going to throw one at you, Todd, and I know we're not going to recommend anything. Todd doesn't. We don't make any recommendations. We're educating only. So I heard this morning, Todd, that Intel, and again, we're not making any kind of a recommendation, good, bad, or otherwise, but I want to talk about something like an Intel just from an educational standpoint. And you're looking at a stock that's gone down dramatically and it pays a good dividend. Is that something that you look at, dividend paying and quality of company? Is that something that one would look at if they were
Well,
thinking about buying?
I think consumers need to look first at the company's strategy for long-term growth and see if they really believe in the logic trail of leadership. The second thing they need to look at with a company like Intel, are they profitable? Do they have current profits? How are their earnings reports been? And then third, what are they spending money on and investing in for the future? And what areas of the world is that going to affect? And what does that do to their anticipated profitability or diversifying Intel's portfolio of business models? And I can tell you on all those merits, Intel's been making some aggressive moves in the energy market and in the semiconductor market, of course, but they are doing some unprecedented activities globally that they're investing in right now that could be monumental over the next 15 years. So yes, but they must be a good business. They must have profits. And if they don't have an economic moat, we don't generally look at them. An economic moat, Ron, is simply looking at companies that have a huge amount of cash on the balance sheet, but they also have a significant competitive advantage in their industry and sector. And we know for a long-standing time, Intel has had a distinct competitive advantage in their industry and sector.
So I want to chat about that just a little bit, because one of the things that I like to look at is probably one of the best buyers of companies in our lifetime. And I would argue that Jack Welch did a great job other than picking his successor. And if you read his book, one of the things he says is pick companies that are number one or number two in their industry. And and if you're buying 100 shares of stock, or if you're buying 1 share of stock, you're basically buying a company. People don't think about that. They think about, I want to buy stock, and they think that's something different than buying a company, because so many people nowadays think of buying stock as gambling. Now, if you think that Intel's number one or number two, I don't know. I'm not going to tell you one way or another. I just looked at it and it said a 5.18% in dividend. Maybe it's something to dip your toes into. Continue our conversation. Todd Halterman is with us this morning, financial advisor guru. But he's not giving anybody financial advice today. We are here to educate. If you want financial advice from Todd Halterman, give me a call, 800-306-1990. I will put you in touch with him. That's what he does for families, all within the sound of my voice. So, Todd, let's talk about this. Right now, we're seeing the market down, and you've been on with us in the past chatting about different strategies to protect your investments. And I think when you were on last month, you talked about the idea that if somebody has a portfolio and it's structured with some of these vehicles that you talk about, educating, not suggesting, that if they're protected from downside. But the question I have is, when the market's down as much as it is right now, do we want protection on the downside, or do we want to take maximum advantage of the upside?
Well, a little bit of both. With the news that's out there, whether you're worried about Russia and how they're controlling the commodity and oil market and gas market, or how the European markets are going to get through the winter with the shutdown of supplies and banking. We're just really interested in watching the American dollars stay put for a while until we can see the market turn around. The Fed is going to continue its inflationary cycle and interest rate run. We speculate that second half of next year, they may reduce interest rates a bit and relieve some of the inflationary pressure. And when this does happen, the market's going to turn around quickly. So our smartest investors are playing on some offense, buying things on sale, but doing it with the defensive strategy. So if their timing is poor, they're not adding insult to injury from the last 12 months.
So do you recommend, and would you explain a little bit about dollar cost averaging?
Yeah, simply put, when people are working and they're adding to their 401k on a monthly basis or every time payroll hits, that money's going into their portfolio on a systematic basis and helps them average the timing of when they put their money in. So if the market's going down, their new contributions are going in a lower price. When the market's going up, their new contributions are obviously going in at a higher price. That strategy is called dollar cost averaging to reduce stress and to increase your opportunity for growing your portfolio. So that's a form of risk management. And people that have cash on the side right now, we're discussing with them how to start using some of that cash to dollar cost average into strong sectors or companies like Intel, we talked about earlier, who have strong signs of an economic moat and growth plans that you may believe in. But that's a good risk management tool right now in this volatile period. And that's one that we use often.
Something, and the idea, and you mentioned again, and we talked about this in the last segment. If you missed it, sorry, but you can go back and watch us on ronsingleradio.com. We have the shows all put up there for you. Is the idea that you don't know when the right time to get into the market is, and putting some money in all the time is probably a good idea.
Well, and I had somebody last week come in that had just put $1 million of their retirement money in the market between August and November of last year. And they did it with not our investment firm. And unfortunately, that $1 million right now is sitting at about $860,000. And they just started their first year of retirement. And they're upset. They're unhappy. They're frustrated, and they don't know what to do, and they're paralyzed with fear. So in that case, we are trying to show them how to protect themselves from a second wave of losses, but how to buy and invest in assets that are on sale, but protect their principal over the next 12 months. So if something happens on the down, they're not going to go down from 860,000 any longer. But there is options for people to buy into the S&P 500 index, the NASDAQ, the MSCI, the Russell 2000. There are tools structured out there to protect principal in those index funds and also have a positive return if the market's negative.
So there's the question then, Todd. I mean, I don't think it matters, what you're getting, where the market is, whether it's up or down. You could be at the top of a cycle or the bottom of a cycle. But if you're in your first year of retirement, you need to have a defensive mindset. Is that right?
Well, yeah, but as the first 2 years of retirement, the sensitive sequence of returns, if you spend 5% of your nest egg and lose 15, that's 20% in 1 year. And let's pretend you spend 5% more the next year and lose 5% more. Well, now, Ron, in your first 2 years of retirement, you're down 30%. And that's a normal standard deviation of the market. And that becomes almost unrecoverable at the expected income that they had at retirement.
Now I'm going to throw something out there, especially when you've got a market like this. And I know it's something that you have to really explore with somebody you trust. Here's the issue, because FINRA doesn't like when I say this. So you've got that portfolio that Todd's talking about. He's got $1 million there. And I'm going to throw it out there that you may have $300,000 or $400,000. So Todd just said, okay, you got $1 million out there and you need 50,000 was your living cost, 5% of that $1 million. What happens if you've got, $400,000 or $500,000 in equity in your real estate? What if you go out there and do a reverse mortgage? Right? Because now you're taking equity that's earning you zero and living off of that bucket instead of the bucket that's down 20%. Because once that's down 20% and you pull that 5% out, you will never ever recover that 5% because you pulled it out. So you can use that 5% of living from a reverse mortgage and wait for your portfolio to come back up again. And then if you want, put that 5% back into your mortgage, because reverse mortgage is optional payments if it's structured properly. Just a thought out there. And I know that a lot of regulators don't like the idea of borrowing against real estate. Not exactly sure why. It seems to me it's just another asset, doesn't it?
Yeah, and it's about cash. It's about, if Americans don't have reserve cash and savings to supplement their needs for a year, then that is an option for sure. To, again, risk management. But we don't advocate doing a reverse mortgage and taking that money, investing it in the market. But we do advocate for doing the reverse mortgage and making sure that you get your debts gone because they're eating you alive, and you have income to live on while your portfolios are recovering themselves. So it can be a very effective strategy. And I want to remind investors out there, real estate on average grows at 4% per year. So if you've got $1 million home, that $1 million home is going to grow an average of $40,000 per year. So if an investor has to use 1 year of equity in the home, that means that on average, that equity should grow back in a year or two just through natural inflation. So it's nice to know that you're not going backwards if you've got to survive with home equity. It just means you have to be careful about how you use it and how long you use it.
And that's great advice, Todd, because I know that you don't want to risk that home equity, right? So taking the home equity out and putting it into a Bitcoin, I would say, is probably the dumbest thing anybody could possibly do. And I'm not a financial advisor. I used to be, but I mean, it's dumb. Don't go buying GameStop, right? Because your friend made 3,000% because the next guy lost 3,000%, right? Don't do those things. But something, if you have to take a couple points, like Todd just said, to live off of while you let your portfolio do its work. Todd, you've used the analogy, and we'll talk about this when we come back, that, that money that's sitting there in your retirement account or in the stock market or bond market, those are like, think about all those every dollar. So like the analogy you just used, they had 1 million soldiers out there working for you, right? They took a little bit of a break, so it's down now, but they're going to get back up and they're going to keep on working for you if they're still there. Todd Halterman this morning, we are chatting about protection, not that kind of protection, you guys. Oh, come on now. Protecting your assets. Now, Todd, back in 2007, right before the real estate market dove, if somebody had followed the guidance that many of us gave, is keep all of your equity out of your property as much as possible. That way, you talk about this moat all the time. If I take a loan out on my house and my house is worth $1 million and I have 80 or 90% encumbrance, okay, if the market drops 20%, I don't have to give that money back that I took out. It's in a separate account with a protected asset like Todd's talking about. Or maybe it's just sitting in a treasury bond that's paying 4% right now, but it's protected from downside. That's one of the tools that we can use in real estate. Hey, go and get a home equity line of credit while we expect the market to drop, and take and put that money into treasury bonds. I don't care what it is. Be careful though. Now, there might be options within the 401k and non-qualified arena that Todd can talk to us about. Am I missing something here, Todd? Are there protected assets or ways that I can take and reposition my assets as far as my stocks, my bonds, my 201k or 401k or IRA?
Sure. I'll give you an example of the couple that came in about a week ago that had lost 14% of their retirement account in the first year. The second thing that they didn't do is the person helping them didn't keep much money in reserve in cash to help provide income to them in a down market, or help them buy assets in a down market when there's opportunity. And they learned a valuable lesson that Mama can't buy things on sale if she doesn't have cash in her pocket. And so what we did for them was we identified S&P 500 index allocations that they had in large cap value and large cap growth. And Ron, what we simply did is we reallocated those investments into the S&P 500 index program that we recommend to folks that allows them to not only protect their principal on the down, but they get to go up 100% of the market when it goes up to a cap. So their particular situation was they wanted 10% more protection on the down. So that means they don't lose any principal. And then what happens is if their portfolio is down 14%, they're only down 4% because the company that holds this index portfolio covers the first 10.
That's pretty exciting. Now,
well, it is exciting, but that's not the only feature. Here's what they were excited about. If the portfolio in this structured tool is down 10% or less, this person will get all of their principal back and they will make a positive return. So if you want protection on the down and it's 10% down, your principal's protected, but then you also get a positive 10% interest credited to your IRA account. So not only is it protection of principal, it's a positive return after they've lost 14% already.
That's pretty exciting stuff. Now, what I don't want to get too specific on it, but can I do that any day that I want to? I buy it today, the market goes down 10% next month. Can I call and say, Todd, I want to cash out of this, or do I have to hold it a certain amount of time?
Well, the things that I do are liquid, which is nice. These liquid instruments can be sold at any time. However, if you want full 10% protection on the down, then you need to hold it 12 months. If you pull it midstream, it's no problem. It's just that it's a pro rata amount of protection on the down if you don't hold it the whole year.
So, speaking as a consumer advocate, what that says to me is these companies are big companies and they don't get to be big companies by losing a lot. So what they're saying is if you've got a strategic investment, more often than not, if you hold it 12 months, you're going to be fairly safe. Otherwise, they wouldn't make a promise like that. Am I missing something?
Well, they are. And they have to guarantee it based on their fiduciary standards and conduct. So the nice thing for us is if you have somebody that's down 10 to 15% and the market goes down another 8% over the next 12 months, you're lucky if you're just even from here. And unless you have some kind of clairvoyance, your neighbor will not be. But in this situation, if the portfolio is down another 8%, you'll find your account going up 8% to help make up for some of the money you've already lost. A true hedge to a down market, but it is guaranteed. It is a fiduciary guarantee that somebody can have that principal protection, partial downside protection, if you will, but also have the opportunity to make money even if the market's down.
To me, that sounds like, especially if you're a senior, that sounds like a great, great product because, if you get the protection on the downside and you're capped on the upside, who cares about that cap? Right? Because the cap is basically saying, and I'm sure it's some high number that you'd be thrilled with if Todd was able to give you a guarantee up front and say, Mr. and Mrs. Jones, I'm going to do whatever that cap is as your return next year. And he doesn't do that, right? But if he was able to, you'd probably say, that's a great deal. I'll take that right now. Think about the idea of not having, how many sleepless nights do you have if you're worried about losing money? And if you can go and say, something, I've got protection and I've got a safety net that I'm not going to lose a lot of money or I'm not going to lose any money, you're going to sleep a whole lot better there. So you've got this product from Todd on that side saying, something, I've got protection. I just shared with you the idea, and I'm a big, big proponent of a reverse mortgage. I like it so much that my parents were in it for many, many years until they passed. and they thought until their final days that it was a great program. Just because you're looking at both items are called safety nets, and you don't have to count on anybody else to provide your family that safety net. Just throw that out there for you. Todd, we got about a minute left. What else you got? Any parting thoughts?
Well, and you said a comment about this is a perfect tool for seniors. I just helped a 57-year-old retire from air traffic control work for the federal government. And his number one thing was, listen, I need to grow this, and I don't want to take my money out of the market when I retire, and I need some money for income. So how do I grow my money in this environment and not worry about taking a huge hit? These tools that are available, it used to be, Ron, that we had to use insurance tools that made people lock up their money for 3, 5, 7, 10 years, and the caps were very low. Today, these strategies are completely liquid, which means you can get in and get out. They also, some of them come at no fee. And so there are just some amazing choices right now where investors don't have to paralyze themselves with fear and sit and do nothing. It really is an option to help protect yourself and have an upside potential even when your neighbor's losing money.
Beautiful thought. Appreciate that, Todd. Hey, if you haven't had a consultation with Todd, maybe you're missing out. I think you probably are. That's just my opinion, but who am I to say? Just your favorite radio host.